Times are very uncertain. Inflation is stubbornly high. Markets are very volatile. Yields have been going up. Is this really a good time to be investing in the marketplace? History would suggest that it is. In almost every time period of crisis, or where there were significant worries in the markets over the past 30 years, has been a great buying opportunity. Of course, there are no guarantees in life or in investing, but there are ways to mitigate the type of risk that you take. One such way is with a fixed maturity portfolio. You're not betting on prices going up or down over the next week or month. What you're investing in is the power of time. If you ask most people, where do your returns in fixed income come from? They'll tell you the yield, the coupon. I prefer to refer to your returns in fixed income as coming from the passage of time. Every day that goes by, you earn that coupon or that yield. But the price moves around. The longer the bond, the riskier the bond, the more that price moves around. Investing for a fixed time period, such as in a fixed maturity portfolio, can be a very appealing way to navigate today's volatility. Prices may move around, they go up and down. But as you get closer to maturity, the bond, as long as the issuer makes good on their obligations, which in almost every case we expect them to, given the high credit quality in today's marketplace, you're going to earn your yield. Particularly interesting to us is the corporate sector. Now, whatever one may think about the period of weakness, economic weakness we're likely to go into, the fact remains that companies have been very conservative as it relates to their balance sheets over the past couple of years. COVID, starting in March of 2020, sent shockwaves through everyone's mindset. And companies were afraid of a much worse outcome than we actually had. So they didn't do the things that we typically see in late cycle. They weren't buying back shares, making a lot of acquisitions, ramping up capital expenditures. Instead, they paid down debt, they termed out debt. So company balance sheets, as a general rule, are in very, very solid state today. And as a result, we think that loss rates, particularly when you're talking about higher quality investment grade bonds, are going to be very, very low. As a result, yields today, call it 5-6%, depending on where you are in the investment grade space, look very attractive to us. We expect interest rates, yields generally, spreads, to continue to be very volatile in the coming year. And that can be unnerving to investors. One way to mitigate that is to actually set a fixed time for your investment. And today, you don't have to invest for 30 years to earn return. Yields, especially in the corporate space, are almost as high at the shorter end of the curve. So one could invest for less than 5 years and still earn a very nice return. For companies that have termed out their maturities, which is most companies today, rising yields is a benefit for both the company and the investor. It's a benefit for the company because their debt servicing is fixed. They issued a 3% bond a number of years ago, and they're going to pay 3% to maturity. But you as an investor also benefit because you're no longer buying that bond at par. That bond's price has now sold off to a level to make the yields more attractive to investors. Might be at 5 or 6%, might be at 80 cents on the dollar. So a company benefits, the revenues might be higher, or are higher, but they're paying the same level of interest. And you as the investor benefit, you get to buy those bonds at discounted prices, which gives you a higher yield over time. Many investors today are rightly concerned about the elevated volatility in financial markets. But staying on the sidelines is not a great solution either, as over any reasonable period of time, you're going to lose to inflation. A fixed maturity portfolio can be very appealing given that. We don't know what prices are going to be tomorrow, but we actually don't care all that much. We know that if you hold to maturity, you're going to earn your yield. And that's what investors want to know today. And we'll be the first to say it's almost impossible to time things perfectly. And certainly if you buy today, you certainly may wish a couple weeks from now that you waited. However, that's part of the beauty of investing for a fixed time period, that when one looks back several years from now, this will have been a great entry point. A month from now, can't say. Could be better, could be worse. A few years from now, given the strong corporate fundamentals and yields starting at much higher points than we've had for most of the past cycle, we think that's a pretty good proposition for most investors.
投资一定有风险，基金投资有赚有赔。申购前应详阅投资人须知或公开说明书。